Hello and welcome to the Investing Iguana, where we help you grow your money like a boss. I'm your host, Iggy, and today we're going to talk about the mistakes to avoid when investing your CPF money. If you're a Singaporean or a permanent resident, you probably know that CPF stands for Central Provident Fund, which is a mandatory savings scheme that helps you save for your retirement, healthcare, and housing needs. But did you know that you can also invest your CPF savings to earn higher returns and grow your nest egg faster? That's right. Under the CPF investment scheme, or CPFIS for short, you can invest your ordinary account, OA, and special account, SA, savings in a wide range of investment products, such as insurance products, unit trusts, fixed deposits, bonds, and shares. Sounds pretty awesome, right? But before you rush to open an investment account and start buying stocks with your CPF money, there are some important things you need to know and avoid. Investing your CPF money is not the same as investing your cash, and it comes with its own risks and costs. In fact, many CPF investors end up losing money or underperforming the CPF interest rates, which are already quite attractive at 2.5% for OA and 4% for SA. So what are the common mistakes that CPF investors make and how can you avoid them? In this video, I'm going to share with you 5 of them and give you some tips on how to invest your CPF money wisely and effectively. Let's get started. Mistake number 1, not meeting the eligibility criteria. The first mistake is not meeting the eligibility criteria for investing under CPFIS. You can't just invest your CPF money anytime you want. You need to meet certain requirements before you can do so. First of all, you need to be at least 18 years old and not an undischarged bankrupt. Secondly, you need to have more than $20,000 in your OA and or more than $40,000 in your SA. These are the minimum amounts that you need to set aside for your basic retirement needs before you can invest the excess. Thirdly, if you are a new investor who has never invested under CPFIS before October 1, 2018, you need to complete a self-awareness questionnaire, SAQ, that assesses your investment knowledge and experience. The SAQ is not a test or a barrier to entry, but rather a tool to help you understand the risks and suitability of investing your CPF money. You can take the SAQ online via the CPF website or through any of the 3 local banks, DBS/POSB, OCBC, or UOB. Once you have completed the SAQ, you will receive a notification letter from CPF Board informing you of your eligibility status. You can then proceed to open an investment account with any of the agent banks and start investing. Mistake number 2, not understanding the investment limits. The second mistake is not understanding the investment limits that apply to your OA and SA savings. Unlike cash investments, where you can invest as much as you want in any asset class, CPF investments have certain restrictions on how much and what you can invest in. For OA savings, you can only invest up to 35% of your investable savings in stocks and up to 10% of your investable savings in gold. These are known as the stock limit and the gold limit, respectively. Investable savings refers to the sum of your OA balance and the amount of CPF you have withdrawn for investment and education. For example, if you have $50,000 in your OA and $10,000 invested in stocks using your OA savings, your investable savings is $60,000. Therefore, your stock limit is 35% of $60,000, which is $21,000. Since you have already invested $10,000 in stocks, you can only invest another $11,000 in stocks using your OA savings. For SA savings, there is no stock limit or gold limit. However, you can only invest in products that are classified as low to medium risk by CPF Board. These include insurance products, excluding investment-linked policies, annuities, excluding investment-linked annuities, endowment policies, excluding investment-linked endowment policies, unit trusts, excluding those with features similar to investment-linked policies, exchange-traded funds, ETFs, tracking local indices, excluding those with features similar to investment-linked policies, Singapore government bonds, and statutory board bonds. For example, if you have $50,000 in your SA and $10,000 invested in unit trusts using your SA savings, you can invest another $40,000 in any of the eligible products using your SA savings. You can check how much of your OA and SA savings you can invest via the CPF website, CPF mobile app, or any CPF service center. You should also monitor your investment limits regularly and ensure that you do not exceed them. If you do, you will have to sell some of your investments and return the excess amount to your CPF account. Mistake number 3, not considering the costs and risks. The third mistake is not considering the costs and risks involved in investing your CPF money. Investing is not free, and it is not risk-free either. You need to factor in the fees and charges that you have to pay for investing under CPFIS, as well as the potential losses that you may incur if your investments perform poorly. Some of the fees and charges that you have to pay for investing under CPFIS include A. Agent bank charges. These are fees that the agent banks charge for opening and maintaining your investment account, as well as for processing your investment transactions. These fees vary from bank to bank and may include account opening fees, annual fees, transaction fees, sales charges, switching fees, and redemption fees. B. Product provider charges. These are fees that the product providers charge for managing and administering your investments. These fees vary from product to product and may include management fees, trustee fees, administration fees, sales charges, switching fees, and redemption fees. C. CPF agent fee. This is a fee that CPF board charges for administering the CPFIS. The fee is 0.35% per annum of the average monthly balance in your investment account, or $25 per year, whichever is higher. These fees and charges can add up over time and eat into your returns. For example, if you invest $10,000 in a unit trust with a 3% sales charge and a 1.5% annual management fee, you will have to pay $300 upfront and $150 every year for as long as you hold the unit trust. Assuming the unit trust earns a 5% annual return before fees, your net return after 10 years will be only 2.9% per annum after deducting the fees. In contrast, if you leave your $10,000 in your OA earning 2.5% interest per annum, your net return after 10 years will be 2.5% per annum with no fees involved. Therefore, you need to ensure that your investments can generate enough returns to cover the fees and charges and still beat the CPF interest rates. Besides the costs, you also need to consider the risks of investing your CPF money. All investments are subject to market fluctuations and uncertainties. You may lose some or all of your principal if the value of your investments falls due to factors such as economic downturns, geopolitical events, industry disruptions, or company-specific issues. Moreover, some investments are more risky than others. For example, stocks are generally more volatile than bonds, and foreign currency investments are subject to exchange rate risk. You need to understand the risks of each investment product and how they fit into your overall portfolio. You also need to assess your own risk tolerance and investment horizon. Risk tolerance refers to how much risk you are willing and able to take on in pursuit of higher returns. Investment horizon refers to how long you plan to hold on to your investments before cashing out. Generally speaking, you should only invest in products that match your risk tolerance and investment horizon. For example, if you are a conservative investor who needs the money in 5 years' time for a housing purchase, you should avoid investing in high-risk products that may fluctuate wildly in value or lock up your money for a long period. Mistake number 4, not diversifying your portfolio. The fourth mistake is not diversifying your portfolio. Diversification means spreading your investments across different asset classes, such as stocks, bonds, and cash, sectors, such as technology, healthcare, and consumer staples, and markets, such as Singapore, US, and China, to reduce your exposure to any single source of risk. Diversification can help you reduce the volatility of your portfolio and improve its risk-adjusted returns. This is because different assets tend to perform differently under different market conditions. For example, when stocks are doing well during periods of economic growth, bonds may be doing poorly due to rising interest rates. Conversely, when stocks are doing poorly during periods of economic recession, bonds may be doing well due to falling interest rates. By diversifying your portfolio, you can reduce the impact of any single asset class, sector, or market on your overall performance and smooth out your returns over time. You can also take advantage of the opportunities that arise in different segments of the market and benefit from their growth potential. However, many CPF investors tend to invest in a narrow range of products or focus on a single market. For example, some investors may invest only in Singapore stocks or unit trusts that invest in Singapore stocks. This exposes them to the risk of underperforming the global market or suffering a large drawdown if the Singapore market crashes. To diversify your portfolio effectively, you need to consider the following factors. A. Asset allocation. This refers to how you divide your portfolio among different asset classes based on your risk tolerance, investment horizon, and return expectations. A common rule of thumb is to subtract your age from 100 and allocate that percentage to stocks and the rest to bonds. For example, if you are 40 years old, you can allocate 60% to stocks and 40% to bonds. However, this is only a rough guide and you should adjust it according to your personal circumstances and preferences. B. Sector diversification. This refers to how you spread your investments across different sectors within each asset class. For example, within stocks, you can invest in various sectors such as technology, healthcare, consumer staples, energy, and financials. This can help you capture the growth potential of different industries and reduce your exposure to any sector-specific risks. C. Market diversification. This refers to how you spread your investments across different markets within each sector. For example, within technology stocks, you can invest in various markets such as Singapore, US, China, and India. This can help you tap into the opportunities in different regions and reduce your exposure to any market-specific risks. You can diversify your portfolio by investing in individual products that cover different asset classes, sectors, and markets. Alternatively, you can invest in products that offer built-in diversification such as index funds or ETFs that track broad-based indices such as the Straits Times Index, STI, or the MSCI World Index. Mistake number 5, not reviewing and rebalancing your portfolio. The fifth mistake is not reviewing and rebalancing your portfolio regularly. Reviewing your portfolio means checking on the performance and value of your investments periodically and comparing them with your investment goals and expectations. Rebalancing your portfolio means adjusting the weights of your investments to restore them to their original or desired proportions. Reviewing and rebalancing your portfolio are important steps to ensure that your investments are still aligned with your risk tolerance, investment horizon, and return objectives. They can also help you maintain a consistent level of diversification and avoid being overexposed or underexposed to any asset class, sector, or market. You should review your portfolio at least once a year or whenever there are significant changes in your personal circumstances or market conditions. You should also rebalance your portfolio whenever it deviates significantly from your target asset allocation by more than 5% or 10%. For example, if your target asset allocation is 60% stocks and 40% bonds, but due to strong stock market performance, your actual asset allocation has shifted to 70% stocks and 30% bonds, you should rebalance your portfolio by selling some stocks and buying some bonds until you restore the original proportions. You can review and rebalance your portfolio by yourself or with the help of a financial advisor. However, you should be aware of the costs and tax implications involved in rebalancing your portfolio. For example, if you sell some stocks and buy some bonds, you may have to pay agent bank fees, product provider fees, and CPF agent fees for the transactions. You may also incur capital gains tax or dividend withholding tax if you invest in foreign products. Therefore, you should weigh the benefits and costs of rebalancing your portfolio and do it only when necessary. You should also avoid rebalancing your portfolio too frequently or too drastically, as this may increase your transaction costs and reduce your returns. Investing your CPF money can be a great way to enhance your retirement savings and achieve your financial goals. However, it is not a decision that you should take lightly or without proper planning and research. You need to avoid the common mistakes that many CPF investors make and follow the best practices that I have shared with you in this video. To recap, the 5 mistakes to avoid when investing your CPF money are: A. Not meeting the eligibility criteria. B. Not understanding the investment limits. C. Not considering the costs and risks. D. Not diversifying your portfolio. And E. Not reviewing and rebalancing your portfolio. By avoiding these mistakes and investing your CPF money wisely and effectively, you can make your money work harder for you and enjoy a more comfortable and secure retirement. That's a wrap for today's episode of the Investing Iguana, where we strive to help Singapore-based finance, investment, and wealth enthusiasts stay informed and ahead of the curve. We hope you found today's content insightful and valuable in your journey to financial success. If so, please show your support by giving this video a thumbs up and subscribing to our channel for more expert advice, market analysis, and financial tips tailored to Singapore's unique landscape. To ensure you never miss out on our latest content, hit the bell icon and enable notifications for all future uploads. We're eager to engage with our audience, so please don't hesitate to leave any questions, comments, or feedback in the comment section below. Our team will do its best to respond promptly and address your concerns. Additionally, we're always on the lookout for fresh ideas and relevant topics to cover in our upcoming videos. If there's a specific subject related to Singapore's finance, investment, or wealth management sectors that you'd like us to explore, please share your suggestions with us. Thank you for tuning in to the Investing Iguana. We're dedicated to empowering you with the knowledge and tools necessary to thrive in Singapore's dynamic financial environment. Until next time, happy investing.